What's up, guys? I'm Ron Sneller, registered financial consultant and investment advisor representative. Today, we're going to be taking a look at the surge taking place in net interest payments on U.S. Treasury debt securities. Now, each year, when the U.S. incurs a deficit, it contributes to the growth of our national debt. Now, the current outstanding federal debt has surpassed a staggering $34.8 trillion. So we are this close to being at 35 trillion. However, what truly counts is the government's ability or inability, right, to meet all the interest payments on this accumulating debt. In the past 12 months through this past May, federal net interest payments have soared to an unprecedented total of $836.1 billion. This figure represents the highest level ever recorded in our nation's history. Now, it's important to note that as long as interest rates remain elevated and the government continues to accumulate new debt while refinancing old debt at higher interest rates, this number is poised to rise even further. Now, to provide further insight into this problem, I've got three informative charts that I want to share with you. So let's check those out. For fiscal year 2024, ending on September 30th, the OMB estimates that interest on Treasury debt securities will reach $1.144 trillion. However, a more accurate measure of the financial burden of debt servicing is net interest on the federal debt, which excludes the interest payments the government pays itself as part of this accounting gimmick that's used for trust funds and other government accounts. So these intra-governmental interest payments are designed to give the beneficiaries of these programs more confidence that their benefits will actually be paid in the future. But these interest payments do not affect the overall budget deficit. So for fiscal year 2024, the federal government is expected to pay itself $255 billion in interest income, making the net interest payments for the year an estimated $888.6 billion. So at $888.6 billion for fiscal year 2024, that would set an all-time high, marking a 35% increase from the previous year, a 136.9% increase over the past 5 years, and a 288.1% increase over the past decade. Now, net interest share of the federal government's spending, it's estimated to reach 12.8% in fiscal year 2024, which is the highest since 1999. And actually, 12.8%, this nearly matches the 2024 fiscal year defense spending, which is projected at 13.1% of government spending. So we've got the spending to protect our country at 13.1% of the federal budget. And now the interest payments on our debt are up there at 12.8%, almost matching defense spending. Absolutely unbelievable. Now, with interest rates elevated compared to the past 20 years and massive deficits forecasted, in fact, for fiscal year 2024, the deficit is projected or forecast at $1.87 trillion. So we're going to be running a deficit over this next year of almost $2 trillion in just 1 year. And again, the deficit is what happens in 1 year, and that gets added onto the federal debt, which is the overall deficits year by year added up, right? So the total negative or total debt that the country's in, okay? So these net interest payments are expected to continue growing, occupying a larger and larger portion of government spending over the next decade. Let's go to the third chart here. Let's see how net interest corresponds to government revenues. So in the late 1970s, rising national debt and higher interest rates led to a significant increase in interest cost, peaking at 18.4% of federal revenues in the year 1991. However, smaller budget deficits and lower interest rates caused this ratio to decline over the following decade. And then from 2003 to 2018, interest outlays remained at or below 10% of federal revenues, despite substantial borrowing. Why? Due to the low interest rates. Remember the Fed stepping in and taking over and had to save the world from a calamity, and they dropped interest rates down and kept interest rates at or near zero for over a decade. But recently, the combination of rising interest rates and that mounting debt has pushed the net interest as a share of revenues to 17.5% in fiscal year 2024, marking the highest total since the year 1992. As the cost to service the debt becomes less and less sustainable, what's that going to mean for the American economy? We're already beginning to see some cracks in the American economy, like rising unemployment, record credit card debt. We've seen the most bankruptcies in a year since 2010. But what's it going to mean for the government and their balance sheet, right? At this point, that's anybody's guess, but the odds are right now, when I'm recording this in middle of July, the odds are now over 90% that the Fed will start cutting interest rates this September. And perhaps that's going to provide some relief to the budgetary woes that they're experiencing. Now, my team and I will be keeping a close eye on all of this, and we'll keep you apprised of any changes or developments that we see. So make sure that you follow along with me here and stay tuned for the latest news and financial updates. Now, I want to say thank you to the team over at First Trust LP and their chief economist, Brian Westbury, for their diligent work in providing us with the research and the data that we use for today's commentary. Once again, guys, I'm Ron Sneller, registered financial consultant and investment advisor representative. Thank you so much for tuning in. I really hope that you found this message informative, timely, and very, very helpful.